Good morning. Morning, everyone. Welcome to another Wealth Coffee Chat. Hope you're all good. Hope you're all awesome and well. Morning, Aaron. A few of the regulars in the house. Good to see you, Beck, Melinda, David. Hey, good morning, Victoria. Luke, mate, haven't seen you for a little while. Good to see you, mate. Anyway, live. Anyway, I hope you're all awesome and well, team. There we go, Clody. Welcome to another Wealth Coffee Chat. Do some little intros and warm-ups while everything's getting going. Good morning, Clody. Hello, folks. Anyway, pressed the wrong button there, but let's get that one going. I hope you're well, wherever you are. But if this is the first time joining, then let us know. And if you didn't already know, turn that one off. Morning, Kevin. Morning, Graham. If you didn't already know, Jason Witten's my name. Most of you do. David's all the way from NZ. Good to see you, David. I'm getting some... oh, there we go. Jason Witten's my name. It says it right there. If you didn't already know. Most of you do, though. But let us know if you're new, if you're popping by. Nev, good morning, mate. How are you? Good to see you. Hey, today I thought we'd talk about the idea of keeping the money that you make. Hey, that's always a good one. I don't know where I read it first, but many years ago, I read the concept that it's not about how much you make, it's about how much you keep. And there are plenty of institutions that want a piece of your action, piece of your income. I feel like that's a little bit blurry there. Oh, there we go. You guys have seen me do the days of the week before, haven't you? And I might just do this, but let's just do quickly. If you were to make $100,000, and let's talk about this. Let's talk about if you were to make $100,000, who gets a piece of the action? Let's call it Monday to Friday, folks. You guys have, some of you have seen this. Some of you may not have. Monday, Tuesday, Wednesday, Thursday, Friday. $100,000. Who gets all of your money when you go to work on Monday? We'll do this quickly so we can get on to the next bit. Put that in the chat for me. Who gets your Monday? Who takes all of the coin if you're earning $100,000 on Monday? The ATO, they take a chunk of your cash. And Luke is saying the tax man. There we go. There we go. Good morning. Hey, great to see. Luke's on it. The tax man gets a piece of that action, gets most of your cash, folks, on Monday and a bit of Tuesday. Who comes up next? We always put this in there, but it's kind of an inclusive or a plus. But there's a contribution to super at the moment. That's 9.5. That's going to go to 10. It's going to go to 12%, right? So super, many of us have got supers that aren't doing so great or are managed by someone else. What comes out next? You got to live somewhere. So the rent or your mortgage. The average Aussie at the moment, man, I heard this the other day. Interest rates have gone up anywhere between 35 and 50% of their after-tax income on their home mortgage and or rent, folks, right? And if you're lucky, Luke, we get to the bills a bit later on, but many people have got credit cards, hex debts, you name it. And then if you're lucky, folks, yeah, if you're lucky, you might get some food, you might get some entertainment. Where's the savings? Where's the investing? Where do you get to invest as we go? There you go. But really, at the end of the day, this is the challenge that most of us have, folks. This is the challenge that most of us have when it comes to the world of our money and our finances. And, we need to understand how we can maneuver our situation to make the most of this stuff because, there's there is ways that we can manage that. And the number one way I say to people when they say, well, I want to change where I'm at, I want to do something better. Well, most of us sitting there right now have an asset. Who's the asset, right? Yeah, that's right. I like that. Whoever said that, pay yourself first. Monday is your day. Boom. I love that. We'll talk about that concept in a minute. Pay yourself first. How do we do that? How do we pay ourselves first? Let's do this. You are the first asset you start with. You're first, all right? And your ability, you as an individual, this human, this person, your ability to earn income is your first asset, folks. Your first asset. That's the number one asset. Now, what can you turn your income into? What vehicle, what financial instrument can you use using your income and turn that into assets? How do we turn your income into assets? Certainly when it comes to the world of property investing. Tell me right now, put it in the chat. How do we, not necessarily wave a magic wand, but how do we use our income and turn it into an investment portfolio? Okay. Certainly, we want to turn it into investments, Tim. What do we need? What instrument? What kind of financial thing do we need? Right, loans, lending. Okay. So, what we do is we take our income plus a deposit, get some lending, and we turn it into investments, assets. All right. Assets. Okay. Excuse me. Team, you are the first asset you will ever own, and your ability to earn, if you can improve your ability to earn income and also save on costs of your income, keep more rather than less, that will accelerate your ability to have assets. All right. So we've laid the foundation of our conversation this morning. Most of us, unfortunately, end up in this situation where we're kind of stuck, right? Yep, there we go. You can use your income plus some deposits. Most of us are sitting on, often we get our first home and we've got some equity, then we can go investing. So let's talk about how we can. There are two functions in our world of there's two streams of earning money in the world of capitalism in Australia right now that are very common, right? They are PAYG. So you have a job or a career, you earn money, or you have a business. Okay. Now let's have a look at this conversation of a game of 30, team. Let's have a look at this game of 30. You've got a job, PAYG. All right. Whoever you are, earn some dollars. All right. So if we earned $100,000 PAYG, what happens? Like you guys said, what happens is as that money flows through, I'm going to put us at the bottom actually. As that flows through, ultimately, you don't get that money directly, do you? You get it. How does that money end up in your bank account? It's called after tax income, isn't it? After tax income. Everyone heard that, right? After tax income. So what happens, and this is just another version of that thing there before, you earn some money. That's your income. You pay your expenses. Oh, hang on, sorry. You get your taxes, your super, all of your stuff out of it, and then you pay your expenses on what's left over. Okay, that's the flow. Okay, that's the flow. And the problem, the challenge with us in the PAYG world is we have to pay our expenses with after tax income. Okay, after tax income. Now, for business owners have a little bit better structure to be a bit more efficient, folks. So business owners, let's say this business earned $100,000. What does a business do next? Well, a business pays for many of its expenses. And tell me in the chat just quickly, what are things in life that a business often can claim as an expense that a PAYG person can't, right? So put that in the chat. And it's very normal. This is not any jiggery pokery. It is just normal stuff, folks. All right. So expenses, cars, phones, yeah, vehicle, exactly, Brad. Computers, computers, travel, etc. Self-development, training, learning, all this sort of stuff, right? So businesses have some functions where you can get a better go of it. So you get some expenses paid first, right? Depreciation. That's right, Victoria. Depreciation, interest, etc. Okay, GST. You get to claim the GST back, etc., etc. So it's fantastic. So many businesses, or if you're a business owner and you run a successful business, one that produces income and takes care of things, many businesses or business owners can accelerate their income often far more efficiently and end up with more net dollars and cents than, many in the PAYG world, right? So then you go, okay, I've got some expenses. Now I'll pay my taxes at a company level. So at company level, it's 25%. And then as an individual, depending on how you get some of that money from your company, then if some of that money came out as dividends or shares or whatever, then you would pay your tax. This would start like that again, right? Everyone cool with that? So it's kind of moving this expenses from an after-tax to a pre-tax world if you can do it with business owners. Now, let's just quickly have a look at how, let's say, all right, well, business owners, whoop-de-doo, I'm not a business owner. What are you talking about, Jason? Well, let's have a look at this. How can we, folks, how can we shift our income here in the world of PAYG? How can we shift some of our expenses to pre-tax dollars, pre-tax, rather than after tax? Tell me in the chat, what can we do? What can we do as a PAYG earner to shift some of the expenses that we have and manage like a business, get some of those advantages like a business, that we can claim some of our expenses before we pay taxes? Or it's kind of like a PAYG variation. Boom, Luke, on it. All right, what we can do as PAYG, we can invest, right? Investment property, boom, Shiva. Your investing becomes or gets treated like, or has some treatment like a business, okay? Not exactly like a business, but in tax terms, what happens is you're allowed to now, if you buy some investment property, right, you're now able to claim the expenses, folks, claim the expenses before you pay tax, or it's more like an offset, but let's just follow along with me here. Is everyone following along? You've got an income. You use that income to buy some property. And what are the two main expenses? One's real and one's on paper. What are the two main expenses we can offset before we have to pay tax, folks? Put that in the chat for me. And a couple of you said it before. And how do we do that? We do that using Luke, PAYG variation. Yep, Cody, a tax variation, right? So, and how do we do that, right? So away we go. So put it in the chat for me. We're running our business of investing, and part of that investing is property. And boom, we get to offset interest and depreciation and some other costs, right? So some of the training, so property management costs, some training and support around investing as well. There are a fair few costs now you can depreciate, right? So now we get to offset those costs before we pay tax. Okay? And then we've got our expenses, and then we pay our taxes after, and then we should receive a net better result. Shiva says, is there a cap? Great question, Shiva. And by default, yes, there is a cap, but not a limit upwards. It's actually a limit downwards. You can only offset as much tax as you would normally pay anyway. So hopefully that makes, exactly. The PRE investment in your mentoring and coaching program is tax deductible also if you own an investment property. So this is the thing, folks, all right? Investing makes your financial life more efficient if you do it properly and you know what you're up to. So in essence, we say, oh, well, that's great for business owners. I'm not a business owner. All these business owners have got all these great advantages. Well, that's true. But if you start your own investing business, then you get very similar advantages as a PAYG. And to be honest, for some PAYG good income earners, it's actually way more stable than owning your own business. I can tell you that one. After owning my own business for 20 years, it's like Jekyll and Hyde. One day it's amazing, and the next day you're like, oh my God, what's going on? Anyway, there you go. So run your own business of investing, folks, and you get to keep more. You get to keep more. Doesn't matter who you are. And, by the way, down here for the investors who want to invest with their businesses, Once you earn some dollars, you can again run that through if you're paying yourself or it's your depreciation, et cetera, et cetera. Okay. So it's pretty good, really, at the end of the day. Okay. What does it look like when it comes to this stuff? And many of you guys have seen this little calculator before, and I talked about this game of 30, right? If you have a look here, now, don't get confused about tax rates, 45% plus the Medicare um, levy of 2%, right? Which means 47. Don't get confused about 45% tax if you're in that tax rate, right? Because I've said this a few times. If you earn $180,000, let's just call it 200,000, right? You're in the 45% tax bracket, okay? Um, but you're not paying 45 cents in tax in the dollar. Everyone cool with that? You're only paying 32 cents because the first 18 you get tax free. Then the next, 18 to 45, you only pay 19 cents, et cetera, et cetera, et cetera, et cetera. Right. So that's kind of the drill, folks. Okay. So it's sort of cumulative as you go. Okay. Um, all right. Well, hopefully that makes sense. I want you guys to understand that even though, let's say, in this game of 30, we want to sort of now run this game here. So this is how you do it, right? I'll just quickly show you. Let's say that is up to 180,000 is 30%. Okay. Let's say we've got some property offsets. Let's say we've got $30,000 worth of expenses, which is interest, interest and depreciation and all that sort of stuff. So you do an offset, and the difference in tax now is a lot less. So you get some tax back, and away you go. So income after tax now. So if we go to that to zero, watch here. So you go 125, right? But if you get 30 grand of offsets, there you go, 154. Okay. So that's how we do it, team. And as either business owners or employees, you've got lots of things you can do. So make sure you do them as investors. Anyway, thought we'd talk about that this morning. Yeah. Yeah, exactly, Alison. It's a quality problem as you earn more. And the thing is that's exactly right, Alison. Your job, if you want this to go well, the more you improve your income, the more investing you can do, right? So, and that just becomes a quality problem. Now your ability to borrow is higher, your ability to claim deductions is higher, and away you go. So anyway, there you go. I thought we'd chat about that this morning. It's not about how much you make; it's about how much you keep. Get those deductions, claim them as you go, weekly, fortnightly, monthly, et cetera, et cetera. Anyway, there you go, folks. Quick wealth coffee chat done and dusted. That's about it from me. I think we're a bit over time, as we normally do. Go a little bit longer than we should, but thanks for joining me. Come along tomorrow. Am I going to be here tomorrow? Yeah, I'm not going to be here tomorrow. I'm having a day off tomorrow, and I'm actually going on a bit of a holiday soon, so I might leave you in the capable hands of either Sam Saggers or Andy Fenton or both of them for a few days. But there you go, folks. Anyway, join someone on Friday, and I'm pretty sure it's going to be Sam for another Wealth Coffee chat. All right, folks. You guys be awesome. Be well. Stay out of trouble. Remember, this thing's a marathon, not a sprint. It takes time to create wealth with your real estate. And there's all little bibs and bobs that we just got to really tweak and grasp and understand as we roll along. Keep this thing on the rails, folks. All right, team. That's it. Done and dusted. You guys be awesome. See you later.